Hi, my name is Judd Tolmen, president of Tolmen Financial, and I'm in my 39th year of helping people with their personal finances. The personal financial world has become so complex, we've started an educational video series called The Millionaire in the Mirror. These videos will cover many different topics and will be available to you and your family at no cost. We will be constantly updating and adding videos going forward. I think you'll see that Tolmen Financial uses common sense combined with math and science, which we call financial engineering. One of these science principles we use was deemed by Albert Einstein to be the eighth wonder of the world, compound interest. To illustrate how powerful it is, let's take a look at two situations. This quick illustration will show you the difference between 40 years of investing as opposed to 30 years. If we fold a piece of paper in half 40 times, what would the thickness be when we got done? Just a hint, it will be measured in miles. And let's see what the difference is if we folded that piece of paper 30 times. Folding the piece of paper in half 40 times with the magic of compounding, the thickness would be over 73 million miles thick, which is a distance to the sun and back. If we folded that same piece of paper 30 times, that would only equal 64 miles, which is about the distance to Chicago. As you can see, waiting 10 years to start your retirement savings could cost you a lot of money down the road. This slide illustrates how the magic of compounding actually works. If we took $5,000 a year and put it away for 40 years at 7% compound interest, you can see this, it starts very slowly, but as that compounding begins to work, we get to that 30th year and we've got about $500,000 built up. So it doesn't matter what age you start, it matters when you start and how long you have, because the biggest gift that you have in your life is the gift of time, and it's worth more than gold. This slide shows how this compounding effect will work in your favor. As you can see, the $5,000 a year when we start out with $1 million isn't really a big deal. The compounding effect does make a big deal. As we use the same interest rate, we can go from $1 million all the way up to $2 million in just a 10-year period. When you look back at the previous slide, it took us 30 years to get to $500,000, but once that money started kicking in and snowballing, it makes a big difference. This next slide is called our 3-circle financial plan. This is kind of the foundation and what we show everyone so that we can all be on the same page and so that each person can develop their own plan according to what their goals are. But these are the major factors in any financial plan. I'm going to go through this rather quickly because I do have another video out there that will go into more detail. The first circle is savings. Savings has to be established. If you listen to the Susie Ormans of the world, they'll tell you 6 to 12 months of your income should be saved. And then she raises that, tells us we need maybe 2 to 3 years. I'm not opposed to that, but it's tough to get that kind of savings put away. That's your emergency savings account. So if 3 things go wrong at once, you've got the funds to take care of those. Because if you don't have that and you have to start dipping into the investments, then it takes longer to accumulate for your retirement. So that is the most important part of any savings plan. The next plan is your investments, or the next circle. In that, we include our house or any property. Some people rent houses, buy them and rent them. Some people have multiple properties or farmland, and that is an asset that you can use for your retirement. The next one is high risk. In that category, gold, silver, things that are a lot more volatile. You know, there is a place for those. We want to be careful when we're in those high-risk places. Stocks and bonds, what I tell people about that, do your research. Make sure you know who you're getting involved with. Buy and hold. Use those dividends if you can to help buy more stock or actually pay those out to you as an income stream. This last leg is the part where you'll probably retire from. This would include any pensions, Social Security, 401k, 403b, IRAs, or a business. Like if you own a business, you may go into retirement, have somebody run it, and still take a monthly cash stipend. Or if you sold the business and invested the money, that would give you income stream as well. Everybody's probably in agreement that 75% is needed in your retirement from the last year that you worked. So in your last year of employment, if you made $100,000, you would have to provide yourself with $75,000 to live in that same lifestyle and be able to increase that a little bit each year to help fight off inflation. The last circle is also a savings account, but it's a special account. We use this as our long-term savings, and combined with that first circle, it gives us a good foundation for your financial plan. So those two together are your base, built on a strong foundation, which holds up your investments so that if you do need to take money out, you're not pulling them from your investments, because as we saw in compounding, if you take money out of that investment circle that's meant for your retirement, you may have just cost yourself thousands of dollars. Our savings goal for everyone is to get to the 15 to 20% range. Now that would be pulling money and putting them into all the different circles we have here, including this last one, which we'll go over. And this last one is the life pension, which is what we're talking about today, which will be available on payroll deduction. This slide's very important too, because just like the saying, you shouldn't have all your eggs in one basket, we believe you shouldn't have all your income coming from one income stream. A lot of people are putting a lot of money in their 401k, and that's their means for retirement, and we'll go over that in a few minutes. The red arrows indicate all the different income streams that are taxable. Social Security was never meant to be taxable. It is taxable on a sliding scale, but I haven't met too many people who stay below the guidelines where their Social Security is not taxed. So your 401k, your 403b, your pension, Social Security, indexed annuities, which is something else we sell, that's safe money. We put that away, but it is taxable. It is a taxable income stream. And then, like we talked about, a business where you would be drawing an income or selling to produce an income stream. Your Roth IRA, not taxable, but a lot of government rules. We do have another video on that. And then the last one is the life pension. Any distributions out of the life pension are not taxable. So since the 401k seems to be the new retirement plan that everybody talks about, when somebody talks about retirement, they're looking at the 401k. We're show an example of someone who's earning $60,000 annually. Of course, we know that some people may be at 30, 35, 40, but hopefully everybody gets above that 60,000. This is just an example of how this works. So if you decided, hey, I'm going to take 4% of my pay and put it into the 401k, and if your company has a 4% match, that means that you will be putting away $2,400. Your company will match that 100% at $2,400, which would give you $4,800 that you would be putting into that 401k. Because it does give you a tax savings on the front end, and that's what this slide's kind of all about. So you only get to take the tax savings on the amount that you put in, and if we're looking at the 22% tax bracket, that would save you $528 per year. Not bad. But if your career, over the life of your career, you put that money away for 30 years, your total savings would be $15,840. Now, if we put that money away for that 30-year period, and I used a very low 4% interest in that bar graph before, we used 7, and you had right at $1 million or $500,000 in 30 years, you would have $290,000 built up in that 401k account. Okay, $290,000 that is now 100% taxable, and the government let you save $15,840. I don't know about you, but giving me that kind of little amount over a 30-year period and then making me pay taxes on whatever the tax bracket is at that point, I don't know. The only thing I can recommend is that I don't know anywhere where you're going to get 100% on your money that first year. So I'm not saying that it's a totally bad idea, but when we go to this side and this person decides, hey, I need to start putting more money away for retirement, and they start putting in an extra 6, which is not getting matched. So they're putting in $3,600. Their tax savings each year would be around $792, giving them over a 30-year period $23,760. That account would grow to $217,000. So if you add these two accounts up, you've got less than $40,000 in savings, and you've got a whopping $508,000 built up in a 100% taxable account. Now, as I said, I used a very generous, very conservative 4% interest. If you're getting 7% on this money, you're up over $1 million in this account. That's 100% taxable. So when we look at the 401k in a little more detail, the 401k began and got popular in the early 90s. So now the people that are getting ready to retire right now use the 401k for most of their career, and they're now finding out that this account is 100% taxable, and they're kind of waking up in kind of dismay because their goal was to keep pumping money in there, and they got to see their account grow. And maybe it grew to $500,000, $1 million. But in reality, they have now taken that little bit of seed money that we talked about in the last slide, and they've moved this into this behemoth that the government basically owns 25 to 30% of. So if you have $1 million nest egg in your 401k, the government actually owns $250,000 to $300,000 of that total account, because every time you take a distribution, you're going to have to pay taxes on that, and we don't even know what the tax bracket will be 20, 30, 40 years from now. So whether you're getting closer to retirement, just starting, or you're already in retirement, you may have a long time that you're going to be paying taxes out of a 401k account, and you need to make sure you know what the rules are before you get it totally funded. So let's take a quick look at where this 401k is after 40 years. Did you realize that you just formed a partnership with Uncle Sam once you started your 401k? It's important to realize that once you enter into a 401k or IRA contract, you've actually partnered with Uncle Sam, and you're in a contract with the federal government. If you don't abide by all of the different rules, which are constantly changing, you're going to have penalties, and you're going to have your money locked up and not available to you until you're 59 and a half. And when you take distributions, Uncle Sam is going to take 25 to 30% of every dollar that you take out on your distribution. And that's on today's tax rates. When it passes to your children or a non-spousal beneficiary, they're going to have to deplete that whole account within 10 years. So they may be in their high earning years, or they may even be taking their required distributions, which could push that money into a 40% tax bracket. Your hard-earned, your blood, sweat, and tears, and the government's going to take a big portion of that when the second spouse dies and it goes to the children or a different named beneficiary. So let's take a quick look at some of these rules. So any withdrawals before 59 and a half, you are going to have a 10% penalty right off the top. No ifs, ands, or buts, and a lot of times they'll take it before you even see your money. When they first started the 401k, they said, oh, you'll be in a lower tax bracket when you retire. Well, guess what? I haven't seen that person yet, and if they are in a different tax bracket, shame on them, because they didn't do a good enough job saving during their working years. The next thing, they keep raising this required minimum distribution age for years. From the time that they started, it was at 70 and a half. Then they raised it to 72, 73 it is today, and they're going to raise it to 75 by year 2030. They act like they're doing this as a favor to us, but in reality, they want these accounts to grow and grow and grow, because as you can see, when you get this account established and you're in your snowball years as far as compounding interest, these things are going to really take off and be a huge account value when they pass to the next generation. And that's when the federal government looks to make their big money. Another penalty, if you forgot to take your RMD or you didn't take enough, the government will penalize you 50% of what you should have taken out. That's a huge number. Along those lines, your beneficiary has to take that money out in that 10-year period, and they don't get out enough. The penalty right now is 25%. Can you imagine them not getting out that last 100 or 200,000, and they get penalized $25,000 to $50,000 of your money all in one fell swoop because they didn't get your money out on a timely basis? The one thing they do give you, if your spouse is named as beneficiary, they will let you transfer that to them without any tax. Now, very important to understand that the only way that a beneficiary or someone that you want to have this money can stretch that out over the rest of their life, which would be a spouse or a child or next generation or a non-spousal beneficiary, is if they are actually named. You can't name this to your estate. If you only listed one of your spouse on the beneficiary line and you didn't list your children, heaven forbid, don't have your children listed, they will have to take that out in a lump sum. And believe me, with the size of some of these accounts, you don't want that. I kind of went over this one already, but this involves that Secure Act of 2020, a non-spousal beneficiary having to take that money out in 10 years or have a penalty. You know, when it first started, it was 50%, and now they've lowered it to 25%. But again, there's an example of them changing the rules after you've already got an account established and after you've already been taking money out for your retirement. Once again, just so you understand that when you're in a 401k, you're in that government contract, and the rules can be changed at any time. Also, I haven't seen any changes that have happened that will be in our favor. Once the government starts taking money and has it set up, it's hard to get them to change and make it good for us. And lastly, Uncle Sam wants to thank you for the contribution. So Judd, what options do we have? You've painted a picture of the 401k, but it's the retirement plan that everybody knows about. Let's look into the life pension and see if that doesn't offer you some better options. All those rules and regulations make my head spin. So let's take Uncle Sam and put him on the bench, and let's see what else we can do. So how can we put Uncle Sam on the bench? What if we had a plan that could do these things? No 59.5 rule, no tax on accumulation, no tax on any distributions, no mandatory distribution, no penalties for not taking out enough when we're in our required distribution phase. Then let's take away this 10-year mandatory distribution for beneficiaries that are not spousal, and then let's offer a tax-free lump sum to the beneficiary upon your death. So let's take a look at the life pension. The life pension starts out with a life insurance policy, and in this instance, for this example, we're using $400,000 of death benefit. So if you take out a life pension and once you've made that first payment, your beneficiary would receive whatever it is that you have chosen for your life insurance benefit. In this instance, $400,000. So let's say this person has paid their first premium, they walk outside their door, and something horrible happens. Their beneficiary will actually get $400,000 in a lump sum, and it's going to be tax-free. Now, the part that we want is the part that has the living benefit, which is where you can take distributions out. And in this instance, let's say this cash value, which is like your savings account, has grown to $250,000. So at this point, you have a $400,000 death benefit, and you have $250,000 in your cash value. Okay, so the interest rate on this cash value policy currently is paying 6% interest. Now, we all want to use the benefits of our life policy and only want to use it as life insurance. So, the way that we take money out of a life policy is we take loans. The reason why we take loans, and in this instance, we can take almost 10% out of whatever's in our cash value each year. So in this instance, we can actually take out $25,000 as a loan. The reason why we take it out as a loan is that if something would happen to you while this loan is outstanding, they would deduct that $25,000 from your death benefit. So in this instance, if that happened after you took your first distribution, you'd have $375,000 that would go to your beneficiary. Now, the government looks at that as taking your death benefit early, and there is an IRS code that explains all that. So let's say we keep taking out $25,000 a year and just keep doing that. If we would start taking loans out against the policy, because everybody knows that a loan has an interest rate that you have to pay back. So there is a loan charge if you take a distribution or a loan out in that first 5 years, and it is 6%. But as you can see, that 6% is also the same amount that we're getting paid in interest. So if we keep taking out that $25,000, we'll be able to take that $25,000 out for the rest of our life. So let's say you start taking your loans out after you've had the policy for 5 years. That loan interest rate now goes down to 1%. So instead of paying the 6, and you don't really pay the 6, they just charge it into your cash value, you now have a 1% loan. Okay, I don't know where you can go anywhere and get a 1% loan. This is a way that you can become your own banker. Unique quality to life insurance policies is that when you take money out as a loan, the policy still pays interest on the money that's left the building. So as you keep taking money out of this policy in loans, you're actually still earning interest, and that interest is 5% because we do have that 1% loan charge. So in effect, because this money is earning 6%, we subtract the 1%, which gives us a 5% interest rate, and that money will actually go back into the policy. Also, remember, distributions on this life pension are not taxable. I know it sounds crazy, but let's take a look at a couple examples. So this is an actual example of an indexed universal life policy. We customize these for each person. We make sure that they are designed specifically and customized for that person, and they have to be set up correctly or they're not going to offer the results when you get ready to retire that you want. So in this instance, this is a 30-year-old. We have they're putting in $100 a month into this policy. Up here, you're going to see the maximum amount that the government will allow to go in this each year. Now, that's important to understand because down the road, you may want to really pump some money into this, when you get closer to retirement, and you'll see in the next example how that can happen. But we're building extra funds in there because if you have a 401k and you can't contribute for a year or two, they don't let you go back and say, oh, I'm going to catch those years up. But this policy, because we're not government controlled, we can do that. So in this instance, this policy bought a base of $125,000 in life insurance coverage. We've paid this $1,200 in this slide for 10 years. We've put in $14,407, and we have in our cash value $13,058. It's not sexy, but when you see the next few slides, you're going to understand. Second page of the illustration, as you can see, your premium or the amount that you're putting in has only gone up in the 11th year to $1776. When we look across here, your death benefit has gone up because we are adding your cash value to your death benefit. At this point, you've got $15,257. At the end of 10 years, you've got $46,912. You've put in $35,732. So we do have more in our cash value than we do our cost for the policy. Now we're getting into the more exciting part. Those last few years, when we get to age 65, we're dumping in about $4,000 a year. I think we have a plan where we could dump in a lot more than that starting at age 59. Remember, 59 is when you can start taking money out of your 401k. But at this point, we've put in $88,000 total. We stopped putting premiums in. We now have a total death benefit of $319,000 and $194,000 into our cash value. Remember, we can take out approximately 10% a year. So we're going to pull out $18,000 tax-free for the rest of your life. And as you'll see, things get really good once we get there. So just in those first few years, we've covered the cost of our policy. And if heaven forbid something would happen, we still have $209,000 in death benefit. We are subtracting the distributions from the death benefit. That makes it tax-free. So in this slide, we've gone over the age 80 mark. But look at this surprise. How many pensions do you know of that will actually increase the amount you're getting over time? So because of the amount of money that we have in our cash value, and the loans that we've taken out, we're actually earning interest on this $708,000 because we've taken loans out in addition to the cash value. So that extra interest rate has allowed us to increase this to $25,000, helping stave off inflation. And we still have that death benefit, but also look at what happens here. When we get to this point, that cash value account actually starts to go up and rise. And that's another reason why we can start taking out more money than we were. So we went from $18,000 to $25,000, pretty dramatic increase. And remember, no taxes. Now, in this instance, I wanted to show you the other benefit. Let's say you wanted to enjoy seeing some money go to your grandkids or your kids or whatever. In this last year that we took distribution, we took $40,000 out. Remember, that's tax-free. We still have $165,000 in death benefit, but we stopped taking distributions at this point, and this is our choice, and the policy will be paid up, and your death benefit will continue to grow for as long as you live. But it's a feature that stops and pays up the policy so it'll never lapse. Judd, I like everything about the life pension that you've shown us, but I'm not 30 years old like the last illustration. What are my options? Great question, not a problem. So what we're going to do is we're going to take 7% in this instance, in this scenario illustration. This person had $600,000 in their 401k. We're going to pull 7% out, which is $42,000. And what we're going to do is we're going to pay the tax on that $42,000, and that might leave us $34,500, maybe a little more, maybe a little less. But in this scenario, that's what we're going to plug in. We're going to do that for 7 years, and then at the end of the 7th year, we're going to start taking out $25,000 in a tax-free distribution for the rest of your life. So totally funded. This pension plan, we've put in $241,500. Remember, we've kept that $600,000 whole, so we're not worried about that. That also will be an income stream. But here's the big difference: if you were just going to play the government game and keep going with the 401k and not adding this, you would only have $40k extra if, heaven forbid, something happens to you. And believe me, these last few years where you're trying to complete your funding of your retirement are huge, because we've already seen what the compounding effect would be. So in this instance, heaven forbid something happens to you in one of these years, your death benefit is going to complete that funding of that retirement plan for your spouse. Going all the way to the last year in which we fund this, we've got a total of $612,518 in death benefit. Now, what we do when we start taking distributions, we have $655,000 in death benefit, and heaven forbid that something would happen, that would go to your spouse or your beneficiary tax-free. Now, what we've done in that next year when we start taking distributions, we lowered that down to the original face amount of $400,000, and that way we're not pulling extra money, because as you get older, the actual cost of the insurance increases. So if we lower that face amount down, we're not paying for as much insurance, and it will give us more income, the ability to keep this $25,000 level. So when we get to this next slide, we can see that this $25,000 continues for the rest of our life. This equals age 89, and there's our original investment from the 401k. We've pulled out $575,000 tax-free. You do the math on how much you saved in taxes. Now, when we get to age 79, our net cash value is $120. We still have $157,000 in death benefit. Then we get to this point, which is around age 84, 85, and you can see where we've taken out enough money where this cash value is actually going to start to go up along with the death benefit. So we've totally funded. The magic compounding is working amazingly. And at the end of that 90 years, we got 575,000 available. So this is that last page of that illustration that we started age 59. Age 98, 99, there's still a 241, 825,000 taken out. But here's the magic spot, age 95. We talked about, one of the spouses making to age 95 if they're both alive at age 65. And then over here is the death benefits involved. If you don't make it that far, you still have death benefit, tax-free all the way through this policy. It just ends up being a great policy. Gives you a lot of different ways to pivot and a lot more choices as opposed to just having a pension or a 401k or even a Roth at this point. Just wanted to show you real quick a couple of the other programs that we have available. If you want to see all your money plugged in, we can actually plug it into this program, and it will analyze everything and give you a percentage on what the chances are of your plan being successful all the way through retirement. And in this instance, these people wanted 96,000. That would include Social Security, 401ks, and all that. Give you a real good sense of what the odds were that would make it all the way through retirement. So I really wish I could do this in a shorter video. I know it's right at 45 minutes, but if you're interested, how do I get started? What's my next step? The best thing to do is to contact me, Judd Tolmen. You can call me, text me, email me at judd@tolmenfinancial.com. We'll set an appointment. There's a lot going on here. It's a different concept, but it's definitely one that we've been using for a long time. I'm passionate about where we're at as far as saving money and not paying taxes. I think this does an amazing job. Even if you were thinking about doing a Roth or you have a Roth 401k, that's a great step in that direction because you don't pay taxes. But the government actually still has regulations on that, and they did have some things that were involved in that 2020 Secure Act. So I really would recommend that you have the different income streams, but you stay away as much as you can from anything that's tied to the government where they have rules that they can change at any point. So once we get your information, we can then set up a Zoom call or a phone call, or if you just have questions that you want answered before you even want to take the next step, we'll be here for you. We'd love to explore this opportunity. I'm very passionate about this life pension. I think it's a great place in which you can draw money from. You can protect your family. The 401k was never meant to be 100% of a retirement account for anybody. It was meant to supplement a pension. But people don't work for the same company for 30 or 40 years in most cases. And if they do, they probably do have a good pension that's involved. But we're here to help you create that alternative income stream and look at different alternatives that will help you immensely down the road and offer protection as well. So the only thing left to do is to say thank you. I appreciate you watching the video all the way through. And again, if you have any questions, just give us a call.